Welcome back, everyone. My name is Michael LeBlanc, Director and Senior Portfolio Manager at Canaccord Genuity Wealth Management, and thanks for joining us again this week at Mike on Money, where we talk about everything that's going on in the markets and everything we see coming up down the pipeline for the next week. This week, we're going to be touching a little bit of more detail on the Canadian federal budget that came out last Tuesday, just as we were airing last week's episode. We'll take a bit deep dive into the details of that, how that's going to affect us, and where we see that going forward. And of course, we're going to cover off everything else that's going on. So hopefully you're all doing well. If you're joining us here live, as always, keep in mind that the information here is for information purposes only, not for educational purposes, only, not to be considered advice. Always do your own due diligence or reach out to us at mikeonmoney.com. Talk to a licensed advisor to see how these different strategies can apply to your situation. And if you are on, if you have a question, please click that Q&A button. Happy to answer any questions that pop up. But if something comes up later, or you want to send something more specific to your situation, just go to mikeonmoney.com. You can contact us there. Has our email, our phone numbers, all our social medias. Feel free to reach out with anything at all there. And you can find all our other videos on there as well. If you listen on the replay or podcast, you can, of course, go there and send us in any of your questions as well. So let's dive into this week and what's going on. Well, of course, as we talked about last week, we talked a lot about the first quarter earnings. We are still in earnings season, and we're seeing a lot of results coming out this week with Microsoft, Mandela's, Raytheon, Starbucks, UPS, and Visa all reporting today and tomorrow. And we're also taking a look at the S&P Shiller's Index for February to see where the Consumer Confidence Index is moving. So all those numbers coming out this week, everything there, I think we're pretty much going to see things positive, but we'll keep reporting on those. We have seen the stock futures drift up a bit on Tuesday morning here on that expectations of positive news, pretty much across the board on all the indexes in Canada and the US. The Fed has been struggling a little bit, and we're going to dive a little bit more into what's going on between the Canadian Bank of Canada rates, the US Fed, and of course the European bank, central bank, on kind of interest rate outlooks and how they're going to be managing that going forward. The US Fed had a maximum employment push where they were moving forward to try to get to that maximum employment rate, or the unemployment rate they had pre-pandemic. Well, they're finding that target a bit tough to get there. They are making some good headway towards it, but it's probably going to be a little bit longer, a little bit more elusive than they kind of hoped for. They were hoping to get there in 2021, but that might not be the case. And we'll get more information as they meet this week as to the plan of pushing efforts along that front, not just with the stimulus packages, but with monetary policy as well. Exxon's received a little bit from their strategy to build up a massive energy trading business to rival the European oil majors. And this kind of fell apart last year when they reported fourth quarter earnings. The first time with a quarterly loss in 10 years, I think, 10 years, or going back at least 10 years. And so they did some budget cutting and re-strategize kind of where they were going to take the company. And of course, now they're in the middle of the merger with Chevron. So they're just taking a shift on the global front. Nothing negative on that front. In fact, we'll talk about oil, and the oil price is doing better this week. And the outlook is actually getting stronger from OPEC as well. Small cap stocks, or small company stocks, have lagged a little bit. We talked about smaller companies earlier in January. when we're in a recovering economy, they tend to do better. Still think there's some good investments. Should definitely be a targeted play, as there's better stories in certain sectors versus others. But they have lagged a little bit from the large cap stocks so far this year. And that's just been that hesitation as we've been going through this year. Of course, the pandemic's still here. Things are improving in some areas around the world, when other areas we're actually seeing things get worse again. So that hesitancy in the market, people are still being a little cautious around the smaller cap names. U.S. business spending on equipment certainly has not slowed down. There's a lot of cheap money out there, and that's great for companies, especially manufacturing companies and heavy equipment companies, to upgrade and become more efficient. So they're out there buying up the machinery and upgrading plants. Of course, that's causing a global shortage in the supply chain for the equipment and for the parts. So that's going to continue as long as we continue to see that cheap money. Makes a lot of sense for companies to do that. Of course, if you've been following the news, the U.S. is moving forward, or looks like it's going to go through in some format. There's, again, probably going to be a bit of back and forth negotiation on this, but they're moving forward with hiking their capital gains tax. So their capital gains tax was pretty low on a global basis, even on a G7 basis. So they're looking at almost doubling at the top end of the wealth scale, and not at the bottom end, but at the top end. So it's really only going to affect about 3% of the income earners in the United States. But this, it's all around this theme of taxing the wealthy more in the United States, which the United States was definitely, again, on a global scale, very behind the rest of the world as far as to how much they tax, especially the ultra wealthy. So we'll keep a close eye on that. Obviously, it's not going to be a straightforward through the Senate. There will be some negotiations. Even on the Democratic side, it's not a sweep to get it approved in its current format. But we are likely to see that happen for Americans. And as far as people up here in Canada, if you are an expat or dual citizenship with the U.S., it probably won't affect you, because the way the treaty is with Canada and the U.S., of course, you pay Canadian capital gains taxes first, and then the U.S. after. The U.S. will still be lower than ours. However, if you own U.S. properties, it might affect you should you be buying or selling, for example, real estate, where you'd have capital gains being triggered down in the U.S. That could affect you. So we'll keep an eye on that and see how expats or people living in Canada might be affected as we see the final form of this as it goes through. OPEC and OPEC Plus continue to meet and keep the forecast for the oil demand growth is unchanged. So still looking very positive on the outlook for oil for later this year, as we do see things start to reopen and demand starting to creep up. Obviously nowhere near previous levels, but starting to creep up. The big outstander right now, if you've been following in the news, of course, India is having global record-setting numbers of new cases and deaths on a daily basis, weekly basis there. So a lot of continued concern around India until that situation gets a little bit more under control. U.S. bank appetite for Treasury has been unfazed, regardless of the Fed's regulatory kind of relaxing their relief efforts on buying up Treasuries. So the U.S. banks' demand for Treasury bills, so this is financing the extra spending that they're seeing out of the U.S., hasn't slowed down, which is positive. That they can keep going without the Fed as they let their waivers expire on their process there moving forward. So we'll see how they might alter that or change that dependent on that demand as it continues. On the COVID front, of course, on the global front, the U.S. is doing a whole lot better than it was. Some numbers in some spots are still gaining, but we're seeing areas like California improving. They are completely open. Any adult in the United States can go get the vaccine, of course, depending on supply availability, but there seems to be excess. The US has even agreed with Canada and some other global countries to start sending their excess out for other countries to administer to their populations. And Canada is certainly at the forefront of those talks to get more vaccines up here. As I mentioned, India in really rough shape. That's pretty much the hot spot in the world we're watching. Here in Canada, things are starting to get better. In fact, even Bonnie Henry came out this morning and said that we have crested, or the data is suggesting, I think I want to be careful how I word that. The data is suggesting that we've crested that third wave. The numbers are still pretty high with, I think we had 2,400 over the weekend. But the data suggesting that we've crested the peak of the third wave. And hopefully that's coming down. Obviously, there's been a massive uptake with the AstraZeneca vaccines as they've lowered the age group to be able to go out and get that. And in fact, here in BC, I think that's pretty much the supply spoken for. It's not all gone. And there's some cancellations and that popping up as people have put their name on multiple lists. But the 40+ group has really jumped on getting AstraZeneca. I mentioned last week I got mine on Wednesday, and yes, I did have a massive reaction on Thursday. So any of you who are sharing that reaction, I'll definitely sympathize with you. It was a day. It was about 18 hours of difficulty, but it passed quickly and back to normal. So if you do get it, yeah, I've heard from friends it's about 50-50 as far as who gets reactions and who doesn't. Anyway, so those numbers are moving along really well, and the supply of the Pfizer vaccine is increasing. Also, the Johnson & Johnson vaccine is supposed to start coming into Canada this week. So I'm sure we'll get more updates on how quickly we can continue to move through the population with our vaccines and see where that leads, especially with this third wave, hopefully slowing down across the country. Let's take a look at the economy this week in the US. The Fed Open Market Committee is beginning a 2-day meeting to talk about interest rates. This, we've pretty much seen whether it's state level or federal level every week, interest rates are on the forefront. The policy around interest rates is on the forefront of discussions. Of course, it lends into economic growth. We talked about companies being able to borrow. Even the real estate market is being driven by low interest rates right now. The US housing numbers have been, just like Canada, have been at record levels, although lower inventories, mostly due to so many people buying up with those low interest rates. So obviously that's at a forefront of discussion. And right next to that is the inflation numbers that we're talking about all around. Try to keep that under control. Alphabet is expected to post a 24% jump in its first quarter sales. So Alphabet, of course, Google's parent company, as more and more ad spending starts coming back after a brief slowdown in that arena during the pandemic shutdown. And Microsoft continues to post higher earnings through the pandemic as still a lot of stay-at-home work happening through the pandemic, even with some things going back to work, obviously with more shutdowns in certain sectors, but a lot of companies just saying, at least until 2022, it's going to be work from home. So, those sales continue as people need equipment and cloud support for all that remote working. Apple is looking to establish a campus in North Carolina as they increase spending on their operations in the United States. They're looking to house about another 3,000 employees, which is, again, good for that economic recovery or expansion in the United States, hiring more skilled labor and also expanding out new areas like North Carolina for a campus that tends to generate a lot of business around in the communities. So very positive for that. Tesla is doing a lot of PR damage, working with Chinese car owners just to reassure them in the middle of the protests that they're seeing around Tesla sales in Shanghai. Obviously, there's a lot of US-China tension right now. And of course, China has probably Tesla's on the global front, biggest competitor with NIO, building electric vehicles. So a lot of tension between those two manufacturers on that home front. That will actually play well for Tesla in India, though, as Tesla is now just starting to move into that market, where of course India has a lot of tension with China right now. So you'll see that population probably favor a US manufacturer over a Chinese manufacturer as they enter that market. US auto dealers are winning in this chip shortage. We've talked about the microchip shortage, whether your computers, for your computers, we're seeing it a lot in the high end, especially gaming computers. People cannot get those graphic chips or the CPU chips, but we're now seeing it into vehicles and all sorts of different products. So what's happened is the car manufacturers have had to reduce production numbers in order to, because they can't get the chips to make the vehicles. And people are walking in and paying sticker price, no negotiations, just buying up full price vehicles just because there's a limited availability for them. So if you're out there shopping for a car, it's not the ideal market out there to get the best price on a new one. Obviously, if it's a used one, you don't have to worry about getting a new chip in there. And the Moderna vaccine is being reviewed by the WHO just for emergency listing on April 30th. So it's just getting the international approval on Moderna, which is of course already approved in a lot of countries, including Canada. Coming up in Canada, the governor of the Bank of Canada is going to appear in front of the House of Commons. Again, just a theme, talking about interest rates, talking about policy. The Bank of Canada did shift a little bit in their messaging, not in their policy yet, but they shifted a bit in the messaging on inflation and interest rates in their last meeting. That sent a little bit of wave or concern wave through the bond markets or interest rate markets. That there might be pressures on them to raise rates earlier than the U.S. Because of higher inflation. And of course, we've been talking about this for a little while. Both countries kind of were looking into 2023, 2024 before they wanted to raise rates. Bank of Canada is basically signaling we might not be able to last that long. Again, I've always kind of said if they get into 2022, I think they're doing well. I think that 23, 24 goal is very aggressive, given what's going on with inflation and the amount of stimulus that's out there. So we'll continue to watch that. It's obviously very difficult for Canada to lead rate hikes against Europe or the US trend, given the size of our economy. It would definitely affect our dollar dramatically and a lot of other things in the economy. So not the ideal solution for Bank of Canada to want to pull that trigger ahead of the US, but we'll have to keep a really close eye on what the new messaging or if that slows down a little bit here through the summer. The Canadian industry is urging the government to end the Montreal dock worker strike, and they're actually in session right now, writing up policy to end that. Obviously, whenever you shut down the supply chain, like the docks, it costs the economy a lot of money, and they're estimating it's about 25 million Canadian a day. So obviously, you want to get that dock open again, and that's pretty standard. When the BC docks are in labor disputes, it's always a lot of pressure on the whole economy because they're entry ports into the country for a lot of goods. Rail shippers. So we've talked about of course, CP Rail made a bid for Kansas City Southern. This was going to create one of the longest single-owned set of tracks from Canada all the way down to Mexico. Everyone liked that deal. As far as CP share ownership goes, it was a good deal for CP. And CN has thrown in a bid to outbid CP for that acquisition. It's a pretty aggressive size of bid for CN, given their size, and the market didn't love it right out of the gate. I do think this is probably going to be a good buying entry point for CN because it did pull back a bit, regardless if they go ahead with their acquisition or CP gets it. I think it will be whoever gets it, the CP or CN. It's going to be good for their share price, but whoever doesn't get it, it'll also be good for their share price because, of course, that's a big financing that comes off as well. So it will start to trade back to normal again. So I do like both those names. CN is in our portfolios and CP is in some of our portfolios. And I've been watching those prices really closely as we see this bid war kind of play out a little bit. On the materials front, on the metals front, on gold, Fortuna shares fell after they made well, obviously the market thought an overpriced bid of $880 million deal for a West African focused gold property, Rox Gold. And we've been talking pretty much since late last year, as just like we saw in the energy front last year, as oil industry was shaken up and a lot of mergers and acquisitions, we're now seeing it on the gold front or the materials front. So we'll probably see a lot more of these in the coming weeks as well. On the foreign exchange front, the euro appreciated quite a bit against the US dollar. US dollar continuing to pull back slightly. We're seeing an interesting thing going on in Europe. In fact, the euro has gone into negative interest rates. So the banks in Europe are basically charging you money to deposit it with them. We've seen this in 2008. The US went into negative interest rate environment for a brief period. Basically, people were paying to buy US Treasury bills. So they weren't getting a 0.25% interest or 1% interest. They were actually paying a 0.25% interest in order to hold US Treasury bills. And we're actually seeing that now in the euro. It is a negative 0.9% was the last number I heard this morning. Obviously that fluctuates, but they have gone into a negative interest rate, which is good for the country. Obviously they're borrowing money below cost, or a negative cost, so it means they're making money. But that probably won't last very, very long. We are in probably just a short state of fluctuation, just like what we saw in the US in 2008. But if you do have money on deposit in euros, you can do a lot of things. You can change to another currency that's not paying negative. You can invest it, obviously, get it out of just cash, and you won't pay that negative rate. But if you have euros in a bank, you should check with yours to see if they've started charging it. A lot of them said they're not going to start charging until May, that they're going to absorb the loss from now till May. But that's not far away. So keep that in mind. And the 10-year US Treasury note moved up slightly to 1.577, but still off its high for the year. Oil price, as I mentioned, has moved higher, basically on OPEC plus holding their outlook despite what's going on in India. But that obviously is a concern around what that's going to mean for the upcoming year as far as global demand goes. So we'll keep an eye on that. And copper continues to push its price forward to $10,000 a metric ton on the London exchange, and that's pretty much been a steady move. They had a big push earlier in the year on copper price, bit of a pullback, and then a move forward again, and that's just supply demand again, losing as the supply chain and demand on materials increases, especially construction materials. And we're also, of course, seeing it in the EV car industry or manufacturing side of things. It's just until more copper mines open up, so more supply opens up, there's going to be upwards pressure on that price. So let's take a look at the federal budget. Last week, as I mentioned, they released the 2021 budget. They did skip last year due to the pandemic and put in place emergency spending to get us through the meat of the pandemic, but they're not done spending. And I think that was the big theme from this to take away, is there haven't been a lot of shoes dropped as far as paying this back. The government is still in spend mode. So not massive effects on taxation or kind of from a financial investing perspective to take into consideration yet. But there are some new features that everyone should probably know a little bit about. Well, one, in 2021, we're going to reach a $354 billion deficit. And then that is a little bit lower than was originally projected, about 382 billion. But really, when we're into those numbers for Canada, I don't know that makes a huge difference. They are hoping to our GDP or debt to GDP ratio to start to fall again below the 50% by 2025, 2026 budget year. But that's the current target. We'll have to see how this year goes, of course. They are increasing the old age security for Canadians over age 75. So if you're over 75, you're probably, I'm sure you're already getting your old age security. You're going to get a lump sum, one-time lump sum, $500 in August. And they're looking to put a 10% increase starting in July on your base monthly payments moving forward. So good news, a little bit extra spending money on your your OAS pension. They're looking to improve access to the disability tax credits and the registered disability savings plan programs for those living and for those who are living with disabilities and those have family members who are living with disabilities. And they're just, so they're putting increased funding into that and definitions to make it more medically relevant terminology in order to qualify for those things. They are adding a tax on luxury cars, boats, and aircraft. So if you're out buying a private aircraft, do so before next January, because you are going to pay some extra tax on anything over $100,000 and any boats over $250,000. So if you're out in that shopping in that market, get in there before January 1st. Otherwise, you'll be paying an extra 10 to 20%, depending on the total value of those purchases. And if you're buying a car over $100,000, same thing. It's going to incur a luxury tax on top of the current luxury tax, which I think kicks in. There's a smaller luxury tax that kicks in, I believe, around 52,000 currently, or 55, somewhere in there. And this one will be a new one for when you pay over $100,000 on the car. Minimum wage is going up to $15. Not a big impact. Major provinces, Ontario has already moved to $15. BC has already moved to $15. I think Quebec wasn't, so they'll be moving up a little bit. But I think they were like $14.50, somewhere around there for minimum. So small. Just making it uniform across the country, $15 minimum wage, but that was pretty much already in provincial budgets in the previous years. GST on new housing, you are entitled, or homeowners are entitled to recover 36% of the GST on a new home up to $350,000, with it being phased out up to $450,000, with a maximum rebate of $6,300. Obviously, this is for the rest of Canada, given there's not too many new homes in BC below $350,000. But there might be some outside of the Lower Mainland. They're decreasing the child care costs. So there's a big investment going into learning and children, the childcare system, aiming to reduce fees by about 50% on average. Outside of Quebec, Quebec has a provincially run childcare system, so it doesn't affect them. But for parents with children in a regulated childcare by the end of 2022. So massive savings there. Kind of wish this came in when my kids were in daycare, but that seems like a long time ago. Student debt proposed. Do kids have debt? I don't know. My kids just owe me a lot of money, I think. Student debt is proposing to extend waivers on interest, so no interest accrual on student loans until March 2023, and also doubling grant money for 2 more years for kids going to post-secondary school. And then pandemic financial supports are proposed to tack on 12 additional weeks to the Canadian Recovery Benefit to a maximum of 50 weeks. The rent subsidy and lockdown supports will be extended to September 25th, 2021. So later this year. So this was all proposed. Of course, it did go through. They did get support from the other parties. EI insurance is putting several $1 billion to extend sickness benefits offered under EI to extend coverage to 15 weeks up to 26 weeks. The support in businesses, so the emergency wage subsidy that went into place last year has been extended to September 25th, with the subsidy rate decreasing as of July 4th downwards. And that was to subsidize to keep people employed and not lay off as many people. And I know a lot of companies that have been taking advantage of that. So that's going to continue until September. And it's going to be renewed, though, after the wind down dates in order to encourage people to hire people back full time or hire new people back to fill long-term permanent spots. They're also put in a bunch of money into skilled trades. So funding provided for 55,000 first-year apprentices and construction and manufacturing. Just trying to, get more people involved in the trades, but get them into the skilled trades where they can earn higher wages and be more employable in the long run. Again, trying to create a more long-term jobs across the board. And then if you are looking to do some upgrades around the house, they are putting some interest-free loans up to $40,000 through CMHC. And this is for any deep home energy retrofits. I haven't done a long read on what they mean by deep home energy retrofits, but obviously it's a little bit more than, upgrading a space heater or something like that. It's obviously going to be some renos, whether you're replacing windows, putting in new high energy furnaces, hot water tanks, or lower energy solutions for any of those. Heat exchangers have a lot of subsidies. So if you are looking at doing a renovation that's going to involve anything like that, it's worthwhile to look into the program and see if you qualify for any of that and take advantage of that free money in order to make that bite of the renovation cost a little bit less difficult. They're also looking at applying a new digital tax for digital services. So these are companies providing you with online services. I know I've gotten a few emails from Spotify and Netflix telling me that they were going to start charging tax for their service, an additional tax for their services. So it's a 3% tax that they're adding. And we're seeing actually a lot of countries around the world, around the globe doing this. Australia, the UK have done this as well. So just looking at new tax revenue streams that don't affect the consumer too much, but of course we pay that tax, but it's a minor increment to our monthly subscription prices. They're limited business interest deductions. This one will be interesting, obviously, for big businesses. If you borrow money to do anything to grow your business, you can write off that interest against revenue. They're now limited in that to 40% of profits in the first year and 30% subsequent years. So that will, be an extra layer of analysis when borrowing to invest for companies, but also for individuals. If you are, for example, borrowing to buy a rental property and you have that rental property in a corporation, which makes a lot of sense to do that for a lot of reasons, you might be limited to your interest write-offs to be 30 or 40% of your profits, so your net positive cash flow from the rentals. So we're diving into more details on this, how that's going to affect things. If you do run rentals, obviously a lot of people sometimes run rentals at net negatives, and that's due to interest write-offs, that this may affect things. So we are looking into more details there and how that's going to be interpreted. It's not started until 2023, so we have lots of time. So nothing to panic about in 2021, but it's definitely worthwhile to get a better understanding of it if you are in that situation, or if you're a business owner. Of course, business owners use loans all the time to grow their business, and it may have zero effect depending on the profitability margins that you're experiencing versus the interest that you're paying, but it's worthwhile taking a look at for sure. Increased taxation on smoking. So if you're a smoker or a vapor, they're adding $4 per carton and a new framework for taxation on vaping products. These are easy targets for the government to go after, as they always have, or at least as smokers tell me, that the price continuously goes up year over year on taxation on smoking and vaping products. And foreign homeowners tax. They're introducing a new one. This is a federal foreign homeowner tax, not on top of the provincial one, of 1% of the home's value if a foreign homeowner leaves that property vacant, starting in 2022. So not a new tax to Canada, but a new tax on a federal. So will increase foreign ownership of properties in Canada by a little bit, starting in January 2022. And of course, just like we have provincially, there's a declaration requirement that everyone will be required to make. On the healthcare system, there is a one-time lump sum payment of $4 billion to help the provinces just clear up the backlog of procedures and treatments due to the pandemic. Of course, if you've been on any kind of list for a non-essential medical procedure, they've been canceling or pushing them out, obviously quite a bit last year during the shutdowns. They reopened again, but they're back into a state of pushing those out again. So there's a one-time fund available to the provinces to try to move those treatments through and get everybody caught up and get everybody healthy again and back to normal. And then also postdoctoral fellowship income was not treated as earned income for RSP room, so they're making a change to that. So if you have anyone you know that's working on their PhD or MBA and we're being paid by the universities for research or anything like that, they now have some extra RSP room that they can use for this year, but they can also go back to 2011 and reclaim any of that room should if they missed out on it. So that's pretty much the highlights. As I mentioned, what does it mean for us these days? Not a lot for this year. Most of the new taxations are into next year, so we have a lot of time to adjust for them. And even as mentioned, the rental property or the business loan one is 2023. So we do have a couple of years to see what that effect is going to be, how broad-based it's going to be, and what needs to be done to make sure, if you are affected, what that impact is, and if you're not affected, or if there's ways to avoid it. We have lots of time to go through that. If you have any questions around any of those things, or if you're concerned about that, do reach out to us at mikeonmoney.com. Happy to keep you in the loop as we figure things out. This is how a lot of these tax budgets work. The politicians put all these things into place, and then the accountants and lawyers have to go figure out what it actually means, and that's the stage we're at now. So as we work with our partners in the accountant side and the tax side, or sorry, the legal side, and we get updates on how these are going to be interpreted, we will get more and more information to you about that. But with that, I'm going to let you go enjoy your day. Hopefully you're having fun out there. For those of you who got the vaccines, congratulations. Hopefully you're all doing well and safe. And I hope to see you all in person at some point this year. But with that, reach out to us. Let us know how you're doing. Let us know if there's any topics you'd like us to cover. And I hope to talk to you again next week. Same time, same place. Thank you, everyone. Bye for now.